Okay, welcome everyone. We'll start LO3, and before that we'll go through before LO4 we'll go through LO3 as well. We'll do a bit recap because I think slightly the things which we covered in the previous lesson. So we'll want to make sure we'll do a bit recap in more detail, and then we'll link to the exact LO4 as well. So because we had a bit discussion on slightly LO4 as well. So in the past, so we'll go through LO3 first, and then we'll go through LO4 as planned. Yeah? Okay, welcome everyone. We'll start. Can you see all slides? Hello, welcome. Can you hear me? Good morning, welcome. Morning, everyone. We'll start our session. So we'll first of all we'll do a bit recap, in LO3 as well, because I think so slightly was mixed. So we just want to make sure LO3 was prepare the financial statement for a group of entities or a group of organizations or companies, we can say. So that will be in our discussion. Those statement we'll discuss. For assignment purposes, really, the matter of picking statement interpretation, or you have data to prepare it. So that will be, I'll go through. Okay, so what do you think? How many types of, we had a discussion in the past, how many types of financial statement we prepare in accounts? So we discussed 4 statements: statement of comprehensive income, statement of financial position, statement of cash flow, and statement of change in equity. We had discussion about IAS1. We prepare all these statements under IAS1, International Accounting Standard 1. We had a bit discussion in the past in financial reporting, and this corporate financial reporting is quite linked, it's quite slightly advanced version of the unit. So if you done that in the past, so it's quite similar, so not big difference. So few bit and pieces new is added to the advanced level. So thus your knowledge is quite useful and help you as well to prepare your assignment. So you can revisit your previous if you've done the financial reporting. So IS2, International Accounting Standard 2, which is about inventory. Inventory we record either at cost or net realizable value, which is mean the sale value, whichever is the lower. Inventory have 3 types: raw material, finished good, and work in progress. That's IS2, International Accounting Standard 2. Okay. Then if we'll say parent company, if you own other company 50% or more, the other company will be called your subsidiary. So subsidiary company mean you own the other company more than 50%, 50 or more. Subsidiary, if you own 20 to 49% shares of other company, that will call your subsidiary. And if you own less than 20%, you call simply the investment. So that's the key you have to keep in mind for this, LO and this learning outcome. Any question, please? If you have, you can carry on asking.
Sorry, I'm late, and thank you.
No, very welcome. So, because we had a bit discussion in the previous lesson, which is more consisting LO4, because it's slightly financial reporting and corporate. I think so you have us highlighted as well in the past. So which we're looking LO3 and LO4 together as well. That will also help us, which is quite similar to financial reporting, which we already done in the past. I think so you had already session about financial reporting, and this is a corporate reporting for slightly advanced level, which is level 4 and level 5. So in group we prepare 4 types of statement we can as a group, group of company like parent, subsidiary, and associate. So first, cash flow statement. If we prepare the cash flow statement, we prepare under IES 7, International Accounting Standard 7, where we look the cash, how much inflow and outflow of the cash equivalents like prepaids and things, and we look total inflow and outflow of the cash under IES 7. Have you deal with the cash flows? Are you prepared the cash flows, Nish?
Yes, in the past.
Okay, brilliant. So that's, really, I'll give you examples and we'll go through. Okay, we can use two methods. One is called direct and one is called indirect method. And really, we need to be remember only three activities: operating, which is mean normal business, day in and out. Investing is mean when you have a spare cash, you're investing in the non-current assets. Yes, like even other company shares, but normally if you have bought the non-current asset, long-term asset, fixed asset, like building, plant, machinery, that's your investment in the business. So you can look around increase or decrease last year, this year, and the difference, if your non-current asset went up, it means you have a less cash. If the non-current asset went down, so it means you have sold them and you generate the cash. Okay, cash can be increased financing activities. Like you can borrow money through bank as a loan, or you can borrow money through equity, issue shares to the general public and raise the money. So if your share capital increased compared to last year, this year, so it means your cash flow went up. If your equity capital is went down, it means maybe you have bought the shares back. So you have a less capital in circulation. So we can look around these activities. Okay, so this is the layout when you start. So what would be the starting point? You look around profit before tax, which you can find the figures from statement of comprehensive income. We call income statements. Yes, then look around finance cost. You add it back in that template. Depreciation is a non-cash expense because if it's a depreciation, you're not paying cash for it.
Yeah.
So dividend received, which is with dividend received is not operating activity because you have invested money into other companies and that's why you are receiving the dividend. So we are first place, we already added in the statement of comprehensive income. We are removed because this is not come under the operating activities. This is come under investing activity. So we remove from here, but we'll include in. Then gain on disposal. If you have a gain, if you sold the non-current asset and building plant, and that was, let's say that was 100,000 and you sold it 105,000. So 5,000 was gain, which your gain you included in the statement of comprehensive income as other income. So what you can do, because that's not operating activities, that's the investing activity. So that's why we'll make adjustment here. If there was gain in the first place, you add it in the statement of comprehensive. Under the operating activity, you remove it. Okay, that's simply, we just plus and minuses we do.
If you make a loss on the sale, then you
If
add
you
it back.
no, if you have a loss, yes, you're right. If you have a loss in the statement of comprehensive income, you minus it before, yes, but in that wasn't operating activity, so you can add it back here, but you can minus from investing activities when we'll do investing activity heading. So that's, which will make adjustments. Okay, then you always look inventories last year, this year. If that's increase, it mean you have a less cash. Yes, if that decrease, you have a positive cash flow because you sold it and your cash balance went up. Because both are assets, one increase, other decrease, vice versa. So be careful. Trade receivable, we look around last year, this year, what's happened. So increase and decrease, you will see we putting the plus and minuses. and trade payable. So these are the most important activities under the operating. These are the major your operating activities, because these are short term, like we said, current assets increase and decrease other than the cash, because the cash itself we are reconciling. So that come cash generated from operations, what you have after plus and minuses. Then always look finance costs, or we also call interest paid, because interest paid first place you have add minus it. So you see here under finance cost we add it here and we minus again here. So net effect is not really the matter, but putting under the right heading, that's why we're doing it. Tax paid, that's a bit complicated. Be careful, always you look around. Tax paid mean during this year what tax you have paid. So it can be previous year you have a liability in the financial position which you're supposed to pay, and this year how much liability left, the difference you paid it. Yes, so always look around, that's your cash, what you paid for it. And then we have a net cash flow. It can be positive and negative, which we'll see the question in a minute. Okay, then then you do the net cash flow. We done the operating, and then you do investing. When you do investing, look around last year, this year, non-current asset, what's happened? It's went up. It means why is went up? Due to new purchase, the value of the non-current asset went up. So it means if it went up, it's a negative cash flow. Yes, because the cash went out from the business. You used it for the purchase. If you proceed something, total proceed, including the gain, proceed, like I said earlier, 105,000. So you do 105,000 is your inflow of the cash. Because you're receiving the cash 100, your asset went down. Yes, that's fine. Interest received. If you have interest received, if you have an investment in other company, that's your cash balance increase. Dividend received, another operating, we minus it here, we add it. Then you have a net cash flows under the investing activities. So that's we need to be very careful. Then we have a financing activities. Financing mean you borrow money, you generate the cash through finance, or you settle it. So if you have a proceed from the issue of the share capital during the year, last year, this year, look the figures, if they increase and decrease. So that's we can look around. We can look around the bank loan. Yes, so if it that went up, went down. If it's went up, it's mean positive cash flow. If went down, it's mean you settle the liabilities, so cash balance is decreased. If you paid the dividend, that can be reduce your cash flow. And then is a net cash flow from financing. So maybe you have a positive there, you have a negative there, and negative there, positive minus 2 negative. And what net cash you have from these all the activities plus the balance, cash balance at the start of the year. It means start of the year mean the last year closing balance, this year opening balance, which is given in the balance sheet, please. And then whatever your figures will come, that will be equal to this year cash balance, which is given in the statement of financial position. So you can see it with the cash being used. That's the key purpose of the cash flow. Reconciling. Any question?
No.
Okay, so what we done in term of, so we went through, we explained, like I explained there, is all been, and then advantage, disadvantage cash flows, which of course is good too, and but it's sometimes a can consuming, can predicted and reconciling. Okay, then we've been given the handout and we can look around the question 6.3 and 6.4, and that question we can use it for assignment if you want to, or you can pick any other of your choice because you're already dealing, you're working in account. So otherwise it's, so if we'll go 6.3 and 6.4, which is mean chapter 6. Yes, can you, I'm not sure you can see or not. Okay, no problem. I think so you can see now. Can you see?
Yeah, now I can see it. So this is from which textbook?
Great. So let's say 6.3 and 6.4 is a full question. So that's why we look this. If we've been given what we've been given the statement of profit and loss, we call income statement. We said profit before tax, you can start. You have all the figures, we'll do in a minute. And then you have a statement of financial position. You have 2 years figures, so be careful. So the difference we can look around, that will help us, so if we look, that's which is available on the Moodle as well, the figures, and then we've been additional information, which is mean adjustments, depreciation for the year you've been given, property plant equipment, how much was costed, how much accumulated depreciation, because accumulated depreciation is not is a cash expense, all the sales and purchase on credit, and other expenses paid in cash, and the dividend we paid. And we've been asked, to prepare and reconcile all the activities, and then you prepare. So what we can do, we can look around now our answer booklet. Yes, but I'll explain you how, because figure need to be make sense to us. That's the interpretation more than. So 6.3, okay. So you will see what we done. We started with the profit before tax. So you go back and look around. Sorry, I'm not sure you can see. Yes, can you see?
Yeah, 6.3, Westlake.
So profit is 1111. Yes, 7. So hope you can see this one too. Yes.
Yeah.
Answer sheet. So what you can look around. Yes. So you've been given. So you can look around where the figures came from. Yes, dividend received and things. So all last year inventory this year. So we are looking the different. So all the working you've been given underneath as well. So
Sir, I don't have access to Moodle. Who do I speak to?
on okay, I'll ask Raman, why not be if you drop emails to admin@ukversity.co.uk, they will, sort out if you don't have it, because you can listen all the previous recording and resources.
Okay.
I can send you, but it's better to be you have access,
Yes, sir.
because we deliver, in different times, and you have all the recording, you have books and journals and articles and all bit and pieces, previous assignments. Yeah. So when you prepare those, you can look around the samples. I can send you some, those I have in my record, but other, everything is on Moodle. Okay, so that's, you can find it, what the net cash flow we have operating. This is a positive. Then we start the investing activity. So it's a carry on. So net cash flows from operating, we have a positive. Then we do the investing. So dividend received, we said earlier, dividend received here, we minus it. You will see here.
Yeah.
Yes, because that wasn't investing activity, that was operating. Operating mean our major business, day in and out we are doing. Investing is extra. You have a spare cash, you invest in different things. So dividend received, we have positive. Proceed on the non-current asset, we have increase there. We have purchased non-current asset during the year, the cash went out, and overall we have a negative cash flow under the investing activity. Then you do financing, look around the bank loan last year, this year in the balance sheet. So you will see here, if I'll take you back, and if you look the bank loan, which is non-current asset, what's happened last year, this year, 250, yes, is increase. So we can look around here, 250 increase. Sorry, 250 is yeah, is increase mean positive cash flow, because we borrow more money. Yeah.
So cash inflows and cost. Yes,
Right.
we add it as a positive. Okay.
And then you will see the shares, yes, dividend paid, and then you can find what the net cash flow from financing. We have a positive. So if you do operating is a positive, yes, Then investing is the negative, you minus it. And then, so you can add it positive, positive together, and then minus negative. What net will be yours, increase or decrease? We have 154,000 is negative. Yes, that means the cash went out from the business. Then you have an opening balance, which was positive. So what is left at the end of the year is negative 107. You go back to your balance sheet and look around this year, your cash balance or cash equivalents balance.
Cash equivalent assets
Yes, so you will see here.
decrease.
Yes, so because cash and cash equivalent is 0, because we have our, if you look under the current liability, because you know you have a negative figures, it means you owe it. Yes, you're
Yes.
using bank money. 107. So our answer came 107 negative. Yes, and is a
Yes.
107 negative. So you can see it is a reconciliation happen under the cash flow. Any question?
Only the student.
Yes, but I mean, you know, in term of assignment purpose, it's just a matter of really looking and preparing your assignment accordingly. You can pick, you know, examples. Of course, if don't have a accounting background and never done the thing, then maybe it takes a while to learn just the cash flows. Of course, you know, we have to go through, or if you don't have basic understanding about cash flow itself. Okay. Then we have 3.2, prepare the group accounts of incorporate, associate, and joint, which we can look around IFRS 10. Parent company, if you own it 50 or more, you're the parent, other company is a subsidiary, you have an influence. We can make the group and we have a control, we can be at the loss and things, you know, that we can look around this. Okay, so what we can, okay. Can you see the slides, please? Okay. Then entity subsidiary company, we can look around what powers and thing mostly is controlled by the parent company because you have a significant influence on. That's why, because if you own it more than 50% shares, and many companies have many parent companies have a many subsidiaries. It can be 50s or more subsidiary companies. The reason is tax purposes, transfers, adjustments, number of creative accounting techniques used to save the taxes. But a lot of legislation change as well to tackle these problems. Okay, first thing, you always look around how many percent, how much were the total asset, how many you bought it. Yes. So you have, so like purpose, assume your 80% you own it. So what is your 20% if you own it? 20% is your non-controlling interest. What is non-controlling interest? Yes, that's we need to be well aware of. Calculate the non-controlling interest. We can look around the share capital of subsidiary, how much was, and 20% of that. Yes, how much retained profit you have previous year, 20% of that. Fair value adjustment, if the value of the asset went down and up, that's 20% of that. So if you add them all, that become your non-controlling interest of that company. Goodwill, okay, always that's the most important thing, calculate the goodwill. So if you have what you paid as a company, that's your consideration. How much was the non-controlling interest and what net asset you acquired that was the value. If the goodwill impaired, like the value of the goodwill go down, so that's, you know, so that's you need to, but what we'll do, we'll look the examples in this our case, yes, and we'll prepare accordingly. Any question? Hello, Sen, you okay?
Yes, I am. Yeah.
Okay, welcome.
Thank you.
Okay, so maybe you not attended the previous session. So we're looking LO3 and LO4. Huh?
Okay.
Okay, so then we have, so we're looking the group of accounts. Yes, we're looking the consolidated statements, and we looking what steps we can follow. Calculate the return earning. We need to be calculate the return earning of the group. So you look all the parent and subsidiary always post acquisition when the date you. So always good to be pleased. You draw the timeline. Yes, like when my accounting period start, when my accounting period finish, because you all working in accounts, you know, and then you can which date you acquired. So pre-profit is nothing to you as a group, and you do only the post acquisition. What you do? Post acquisition, when you acquire the company. Less at acquisition, how much was, and the group shares how many percent. Yeah. So that's which we can look around. I'll go through example in a minute. Less impairment. Impairment is a loss. Goodwill, what we have, it can be how we can find the goodwill. What you paid and what was the net asset value of the company at the date of acquisition. If you paid more than the net asset value of the company, like in accounting equation, then it's mean you paid for the goodwill, and you can say this is what the good. If their values after that is decrease the goodwill because the company involved or the shares or number of reasons, that's you can call impairment. Impairment is a loss, huh? That's why we do minus. So non-controlling interest we can, and that's which we need to calculate. So what you do now, simple, you can look around both companies assets, just combine them. Only the adjustment really is intangible goodwill figures, which we'll do the calculate by following the working steps. Uh, no other non-current asset add parent and subsidiary. Current asset of parent and subsidiaries add them. Only intra-company trading if selling A to B and B to A. That's if you're preparing the combined account consolidated. That's not your profit because you're the same group. That's why we need to eliminate. And we look around share capital, return earning of both, only the post acquisition of parent all and subsidiary, non-controlling interest. So what we done the working, if you look around the working heading, and we can combine them. Yes, and we can prepare, the total asset figure should be minus liability net asset, and net asset figure is always equal to the equity figures, like accounting equation point of view. So that's we been a step-by-step approach, which we can look around in a, when you do the return earning, which is profit and loss consolidated, you add both companies revenue. If intra-company any trading happen, just minus cost of sales, you look around both companies. Gross profit comes after adding these minuses, operating profit, and so on. Attribute mean maybe one company 80% like parent and 20% will go as a non-controlling interest. Huh? They're combining the profit, which we'll look in a minute. Example that will help to clear. Huh? That's example intra-company you eliminate. And that we have a question 8.4 and 8.5 for our assignment. So what we'll do, we look at a handout now, 8.4, 8.5. So let's look 8.4. I'm just looking one. So go 8.4. So you will see here what is the 8.4 that he did. You've been given two companies. Yes. Two companies profit and loss accounts. Yes. That's we need to consolidate group statement. You're preparing one statement. Yes. From this, you've been given additional information. We acquired 70% of that. Yes, during the year we sold goods and services. That's we need to eliminate if we earn the profit, because that profit when we'll do combine them together, that's including for one is a cost, other for is a profit. So that's we need to eliminate it. Huh? Okay, dividend if you paid one to other, that's we need to make adjustment, and we need to prepare the consolidate. So what we'll do, go back to, because this is a consolidated profit and loss. Huh? are we preparing statement of compliance? Go 8.5. Sorry, 8.4 was. Okay, can you see here? Can you see both, please? Yes?
Yes.
Okay, so what we need to do, please, we need to look around the revenue. Yes, consolidated revenue here. Cost of sales and how we done it. Yes. So
Yeah.
if you go down, you've been given here working. So please, it's good to look around. You have both companies. Yes. You have intra-company trading. They sell each other. And we have a net revenue. That figure stayed going there in your templates. Yes. So that's there. Cost of sales. So go there, cost of sales. We have a parent subsidiary. Add them together and intra-company trade. You can eliminate it. And that's your cost. So you've been given all examples. So please, it's good to look around and then you're doing all distribution costs. You're adding them together. Admin expense of both companies, adding them together. Of course, you know the revenue minus cost of sales, gross profit minus other expenses, profit from operation, then finance cost, which is interest you paid for loan, and then you have a profit before tax, then you have a taxes, and then you have a profit from continued operation, what you have as a company. So that's the way we need to look around. And thus you have for profit and loss, or we can consolidated statement of comprehensive income as a group. Okay, then there can be even more complicated in the foreign currencies, conversions and things. But at this level, we are just looking this. Okay, especially in ACC advanced financial reporting, slightly, there are the more issues within these, statements. So that's, which we can look around now. Statement of financial positions to company. We've been given additional information if they are trading any year is adjustment their non-current assets and things. So we have to do some working, some adjustment. So you've been given how many percent, how many total shares were the subsidiary, how many we acquired and bought it. That's 60%. So what will be 40%? Non-controlling interest. So you have to establish the group structure so you can follow the steps. How much was the fair value of the asset, which is non-current asset? How much was the carrying value? Fair value means the market value. You learn maybe mm, impairment or adjustment of assets. Yes, revaluation. So that's which we need to look around. That's 600 is the difference. So it went up, went down. That's we need to be make adjustments. We do debit the non-current asset and credit the revaluation surplus. So that's the adjustment entry, debit and credit. And then goodwill, how much you paid, always given the information within the question. How much was NCA? That was 40% NCA, non-controlling interest you've been given. How much were the asset and how much you acquired? What is the 40% value? And net asset at the expiry date, these were you minus impairment if you have the goodwill given in the question and your goodwill is coming 47. So you do please these little two adjustment and use this template, of course, that will help, and return earning. And then all the figures, because as an assignment purposes, of course, you have to combine them. So you have a goodwill, pick the figures from the working, tangible asset. What is the tangible? Which have the non-current asset, physical substance. We adding them both companies asset and revaluation, any adjustment, revalue their asset values. That was given in the question. We add them, and if they have any investment in them, so we add them. That's our total. Then you do current asset. If they have intra-company trading, just that need to be adjusted. But in this one, we don't have it. Just add them together. That's your total asset. You look around, then parent, all the share capital, share premium, retained earning, and subsidiary non-controlling interest. And retained earning you already calculated at the top, and the non-current liabilities, which is parent and subsidiary, both combine them. Current asset liabilities, if we have combined them, and that's your total liabilities and equity figures and total asset figure. They should be equal. My debit side and my credit side always it should be equal. Any question? No? Okay, guys. So that is our. We can look around our non-current asset and adjustments. That's which we have to look around for our LO3. Yes, in changes in the group structures can be if the new company come, if the company shares and we make certain adjustment, but if you own 50 or more percent, that called your subsidiary company. So that's and the group structure you've been given some extra reading, please. It's good to be, you can copy the link, and you've been given some question and links as well, which when you do your assignment, which is. And if you want to do merit criteria, we can look around, analyze the accounting requirement that related to the foreign transaction. Of course, we have to make adjustment in the foreign transaction. We have to find the value in the currency exchange. We have to look around the parent and subsidiary transaction. We need to look around the legal structure. We have to follow international accounting standard. That's we have a discussion in the previous lesson. And that's we included some stuff. If you want to look around the distinction criteria, we've been given some sample assignment, evaluate the needs and prepare the detailed financial statement when change the group structure. Yes, so we can make adjustment accordingly in the new group structure. Fair value adjustment is of course the market value and the value, and we do impair our assets accordingly and revalue our asset accordingly. We need to be look around IAS, accounting standard for impairments. And you've been given ACC article for this, so it's good to look around. That was our LO3. Any that's which we had a bit discussion, and you already couple of you learn in the financial reporting. Okay. During our previous lesson in previous, we discussed about ratios, and you hope you already learned the ratios in different subjects. So this LO4 is more focused about, and LO3 is more focused about statements, and LO4 is more focused about the financial ratio. So we'll discuss today's key is our ratios. So ratios we discussed in the previous lesson as well. We have how many types of ratios we categorize? Major is 4 categories: liquidity, profitability, financial position, and use of resources. That's we need to look around. Please, in the formulas we have current asset divided by current liabilities. Yes, quick ratios. So please, you have to follow the formulas. The two statements, statement of financial position and statement of comprehensive income. So these two statements you have to use to collect the figures, which we done in the previous session, this already, because that was, the financial reporting and corporate, we slightly, Okay, so any question from both of you, if you have, please? You both working in account. Hussein, you working in accounts, yes? You done in the past account.
I did an accounting job. At the moment, I'm working in a bank.
Okay, but you're okay in terms of when I'm talking about financial ratios.
Exactly. Yeah, I did for this year.
Okay, brilliant.
The only thing, I didn't attend yesterday session, so I texted even Ramjat, and I was asking if you can just send us the recorded material for today and yesterday.
No problem. I'll send you all. Do you have access on Moodle?
On Moodle, yes, I have. Yeah, I can log into the module. Yeah.
Yeah. So we have all the session recording available, like LO1, lesson 1, LO2, lesson 2, LO3, lesson 3. Yes.
Okay,
And
perfect.
plus I will send you this time, which we deliver. Huh?
Thank you very much.
They will upload as well back end on Tuesday, but I can send you as well. Huh?
Thank you very much, sir.
Okay. If you don't mind, in the chat, you can drop me either message, either via email or WhatsApp. Huh?
Yeah, I will WhatsApp you.
Okay, brilliant. In the group, just say and send me the recording. Huh? I
I
can
will.
file.
I will.
And
Thank you very
just put your, yes, I can send you via WhatsApp, or I can send you via email as you want.
Thank you. You've been very helpful, sir Andrew.
Very welcome.
Thank
Okay,
you.
so we can look around the formulas, please. Of course, you're both working in accounts. We had already discussion on this before during our last lesson as well. So we can look around these, So first is liquidity, we said. Then second is the profitability ratio, gross profit, operating profit, return on asset employed. So you can do at least 2 or 3 ratios when you do assignments. Huh? Assignment per se. That's the main thing, interpretation of ratio. Use of resources, also known as efficiency ratio. How quickly we convert inventory, how quickly we receive money from the trade receivable from debtors, how quickly we pay to the creditors, always could receive quicker from the customer and pay later to the supplier at the reasonable time. So we have a safety net. So like, in 30 days we are receiving, and in 60 days we are paying to the supplier. So 30 days we have a safety net. So always businesses want to be, they have a cash, because cash is a lifeblood for business. Okay, that's, and then we've been given is in that's, we looked in previously already in the last lesson as well. Return on capital employed, we can look around profit from operation divided by total equity plus non-current liability. And that's, you can calculate, and that's help you to interpret. You can look around 2 years, and you can say increase or decrease or enhance or show the relationship. You can say return on capital employed, it shows the relationship between profit after tax and the total equity figures. Huh? And the equity figures. So all these ratios are, if you're looking liquid, 2 to 1, £2 worth of asset, £1 worth of liability. That's good for business, is most liquid. Huh? Most strong. Sometime inventory is not a liquid, because maybe the inventory is outdated or expired, or maybe no one is willing to buy. The fashion industry change, depend which industry we are, in current liabilities. So that should be normally 1 to 1. £1 worth of asset, £1 worth of, that's a good. Okay. Position, then you can look around inventory turnover days. Yes, that's, trade receivable. So all you've been given formulas. So you can pick, 1 or 2. Gearing mean is also known as financial position ratios, high gear, high risk. Interest cover ratios, how many time our profit is higher than the finance cost, which is interest on borrowing money. If we are borrowing money, we have to pay interest. Okay, then as an example, we pick, the figures from Anika and Papika, two company. We calculated the gross profit divided by revenue, or we call sales, or turnover is the same thing. So that's 45%, is 52%. That's, Papika is higher than Anika. So we can say uh, gross profit show the relationship between gross profit and sales value of the sale. And Anika is 45%, and Papika is, which is 7.2%, 5% is a higher. So Papika's performance is better than Anika's. But the investor need to look around the other ratios as well, and look around the current environment before making the final decision. Because maybe the ratios before COVID, and then COVID happened, and then everything shut up. When you invested based on just ratios, maybe you're not well off. Huh? So we need to be look around. Okay, then operating ratios, which is meeting all other overhead expenses, that's a 9, and that's the 11. So still Papika is a better. When you look the gearing mean if your debt and equities, and it shows high gear, high risk. So that's it, 13%, that's 71%. So if we look, the profit difference is only 7.5. if you look the risk difference, that's very huge. So that's why we not prefer to be investing in Papika. It's better to be investing in Anika. No doubt the profit is less or the return is less, but the risk is less, very less compared to, so very high risk. So normally in the business, we say high risk, high return, higher the beta, higher the return. So that divided by equity, that's 15, and that's 255% risk. That's gaining ratios, which indicate the risk. So their profit is 11.6 times higher than the finance cost. There is only 3, so is Papika is more risky. Asset test ratios, which is liquid ratios, 1.22, is mean every 1 pound of liability they have 1 pound 22 pence of asset, and then other is only 60 feet, so Pika is more risky. So on the basis of overall, we can draw the conclusion, we can say look around other companies, other areas performance as well, and we can draw the strategy to improve these ratios in the business, like moving business abroad or making sale, dropping price, that will help. And this is different stakeholders look different purposes these ratios, like government is interesting, they are paying the fair taxes and think, and then we draw the conclusion based on that the Anika is a better company to invest. As an analyst, you can give your view to people, and then we can draw. So that's which we have, that's we done in the past. Okay, any question? Then we have a bit discussion about creative accounting. That some people are very creative, like Enron and various other companies been involved. And so we've been given why people create the creative accounting. And I included the link of the question and from the handout, which is available Osman. And that's you can use it if you want to add the examples in your assignment, or you can pick the example from your own choice or from the scenario, whatever, which we'll go through in our next lesson assignment discussion next week. And in between, if you have any question, please drop me email ukversity.co.uk, and I'll try my best to get back to you as soon as possible. Thanks for attending this session, and I hope speak to you. If you have any question, please you can ask. Any question?
Yeah, just quick one. Next week, when will be the session day? Is it the same Saturday, Sunday?
It's same on 9 o'clock on Saturday, because that
Yes,
will be the last session assignment discussion. That's the most important, which we'll do all the recaps.
right. I will be going holiday for about 1 month and 1 week, so I will not be able to attend. Actually, I will be traveling on Saturday, so I will be on
No
flight.
problem. I can send you the recordings.
Please,
And
yeah, thank you very
if
much. Yeah,
if you not you want to discuss one, we can book one-to-one tutorial.
of course, after I come back, but if you send me the recorded, that will be fantastic.
No problem. I'll send you recording.
Thank you very much, Andy.
Okay, brilliant. Thank you. Even when the link you have, if you click that, and you can find the recording there as well, because I do the cloud version. So, but we can send you.
I will. Thank you.
Welcome. Have a nice weekend. Speak to you
The
then.
same. Wish you the same. Okay, thank you.
Best wishes.
Just let me say,
Okay.
the next lesson, I won't be able to.
Sorry. Yes, just 1 second.